W-2 earners, there's a good chance you've heard of an HSA, also known as a health savings account. But almost nobody explains why smart W-2 earners are using it as a tax strategy, not just a health account. And the difference is extremely important because when used the right way, this one account can lower your taxes, grow tax-free in the background, and give you tax-free money later. So in the next couple of minutes, I'm going to show you why smart W-2 earners are using the HSA differently, how it actually works and the mistakes that most people make, and how to use it to build more tax-efficient wealth over time. Let's start with the one thing most people get wrong about the HSA. Most people treat the HSA like a short-term medical spending account. They put the money in and then they spend it right back out. They go to a doctor visit, get the prescription, the dentist, the glasses, etc. And technically, yes, that's allowed, but that's not where the real power is. Because when you use the HSA that way, you kill the part that makes the account so valuable long-term. You turn a strategic tax tool into a glorified checking account for healthcare. That's the misunderstanding. Most people think they're using the HSA correctly, when in reality, they're draining the very thing that makes it so powerful. There's a big difference between using an HSA and leveraging an HSA. Using it means you contribute and you spend it. Leveraging it means you contribute, you invest it, let it grow, and use it strategically over time. And that's why the smart W-2 earners don't rush to empty the account. They leave the money invested. They let it compound. And they treat it much more like a stealth wealth building tool than a simple medical reimbursement account. That's the moment people realize they may have been using the account completely backwards for years. To understand why W-2 earners use it differently, you first need to understand what makes this account so unique. The reason high earners quietly love the HSA is very simple. It wins 3 different tax battles. First, the money goes in pre-tax. That means every dollar you contribute lowers your taxable income today. Second, the money grows tax-free while it's invested. So no tax on dividends, no tax on the interest, and no tax on the gains inside of the account. And third, when you use the money for qualified medical expenses, it comes out tax-free. That combination is incredibly rare. A traditional 401k gives you a tax break now, but you pay taxes later. A Roth IRA makes you pay taxes today, but gives you the tax-free growth and tax-free withdrawals later. The HSA is different. It gives you the deduction now, tax-free growth while invested, and tax-free withdrawals later for qualified medical expenses. And that's why people call it a triple tax advantage account. And they're right. It's the only mainstream account that gives you all 3. That is the exact reason why high earners quietly love this account. But the real edge is not just that it's tax efficient, it's how the smart W-2 earners actually use it. This is the move that separates average users from strategic users. Most people use the HSA to cover medical bills right away. And again, that's fine if cash flow is tight. But if you're a high income W-2 earner and you can afford to pay your medical costs out of pocket, the better move is usually to leave the HSA alone. Let it sit. Better yet, let it invest. Because once that money gets invested and left alone, the account starts behaving very differently. Now, it's not just covering today's expenses, it actually begins compounding, and that changes everything. So the real strategy is simple. Contribute to the HSA, invest the balance, pay your medical expenses out of pocket when you can. Save all your receipts, reimburse yourself later. That reimbursement can happen years later, not next week, not next month, but actually years later. As long as the expense was qualified, happened after the HSA was established, you can keep that receipt, pull the money out later, tax-free. That's what turns the HSA into a stealth investment account. You are essentially creating a bucket of tax-free money that can keep growing in the background while you live your life. That's the move, that's the strategy. And once people understand it, the HSA stops looking small. Now, let's make this real with an example, because once you see the numbers, the strategy starts to click fast. Let's keep the math very simple. Imagine you max out your HSA every year and you invest it. Let's say you contribute around the annual family limit consistently and let that money grow at a reasonable long-term rate. Over 10 years, that can turn into a very meaningful tax advantage bucket. Over 20 years, it can become much bigger than what most people expect. And remember, this is not just growth, it is tax-free growth. That changes the math in a very big way. Because if that same money were growing in a taxable account, some of the return would be leaking out through taxes over time. Inside the HSA, it compounds cleaner. Now, layer on the fact that high income W-2 earners are often in higher tax bracket, that means the deduction on the way into the account is more valuable. And if you're saving receipts for future reimbursement, you're not just building tax-free growth, you're creating future tax-free access too. And that's why this stops being just a healthcare account. It starts becoming a serious long-term tax advantage asset. This is the point where strategy stops sounding small and starts sounding smart. But as good as this is, it only works if you actually qualify. And that's where some people get caught. Super quick, if you want to learn more about legal tax strategies that are available to high-income W-2 earners, join our free school community using the second link. Inside, you'll get step-by-step guides, training replays, ongoing Q&A support, built specifically for high W-2 income earners who want to stop overpaying taxes. All right, let's keep going. Again, this is a powerful strategy, but it starts with having the right health plan. To contribute to an HSA, you generally need to be enrolled in a high deductible health plan. If you're not on one, the strategy usually does not apply yet. That's the first filter. Then there are annual contribution limits. Those change over time, and if you're eligible for catch-up contributions because of your age, that can increase what you're allowed to put in. So people assume they have an HSA because their employer offers a healthcare account. Not always. Some accounts are FSAs, some are HSAs. Some people mix them up. And that confusion matters because the rules are completely different. So if you want to know whether this strategy applies to you, you need to check the actual type of health plan you're on. Look at your benefits. Check whether the plan is HSA eligible and confirm the contribution limits for the year. Don't just assume you're already optimized because the option exists. A lot of high earners miss this simply because they never review their benefits properly. This section answers the biggest questions most people have. Does this actually apply to me? If it does, the next question is simple. How do you actually use it the smart way? Once you qualify, the actual playbook is simple. First, contribute through a payroll if possible. That keeps the process easy and consistent. Second, don't leave money sitting in cash forever if your HSA provider gives you investment options. Invest the balance. That is what unlocks long-term power. Third, if your cash flow allows it, pay current medical expenses out of pocket instead of draining your HSA account. Fourth, save all your receipts, not in a messy email folder, not in a pile on your desk, but put them in one dedicated place, a digital folder, your cloud, a PDF folder, whatever works, just make it organized. Fifth, reimburse yourself later, strategically, not automatically. And finally, treat the HSA as a part of a broader tax plan, not just a standalone trick. This works especially well when paired with other tax efficient moves like your 401k, different Roth strategies, and better overall year-round planning. Check out my channel for videos on other tax efficient moves you're likely missing. That can help you save 20, 30, even over $100,000 a year. That's the real playbook. And once people understand the sequence, this is usually the moment they start thinking, okay, I could actually do this. But before you go set this up, there are a few mistakes you need to avoid. The first mistake is spending the HSA immediately. That's the most common one. The second is leaving the money in cash instead of investing it. The third is losing your receipts. All of that matters because the whole delayed reimbursement strategy depends on having a clean paper trail. Another big mistake is treating the HSA like it's a bill-paying tool. That mindset keeps the account small. Then there's the confusion with FSAs. They're not the same, and if you treat them like they are, you can end up making poor decisions with both. Some people also pull the money for non-qualified expenses too early and create avoidable tax and penalty consequences. And many people do not fully understand what changes after 65. The point here is simple. The HSA is powerful, but only if it's used strategically. This is where most people begin to realize that the account itself is not the edge. The way you use it is. So let me show you what this can look like in real world. One of our clients who's a high income W-2 earner making a strong income, doing most things right. They had an HSA. They were contributing to it, but they were also using it the same way most people do. As soon as medical expenses came up, the account got drained down. So the account never really had a chance to grow. We changed the way they used it. They started maxing the HSA intentionally. They invested the balance. They paid current medical expenses out of pocket instead. And they saved their receipts in one organized folder for future reimbursement. Did this one move alone slash their entire taxes in some flashy six-figure way? No, but that's not the point. The point is that it became part of a much bigger, better overall system. Now they had a cleaner deduction going in, better tax-free growth over time, and more flexibility later. That is why it's called a quiet long-term advantage. It may look small next to things like real estate or business deductions, but when you use it correctly, it becomes a very important piece of the bigger picture. And this is where the viewer sees how the strategy fits real life, not just theory. So if you want to start using this the right way, here's exactly what to do next. First, check whether your health plan actually qualifies. Second, confirm the current contribution limits. Third, set payroll contributions so the money is getting into the account consistently. Fourth, if your HSA provider allows investing, move the balance into investment options instead of leaving it parked in cash. Fifth, create a simple receipt storage system. Sixth, stop spending it automatically every time a medical bill comes up, if your cash flow allows you not to. And seventh, build a HSA into a broader tax plan instead of treating it like a one-off benefit. This is not complicated, but it does require intention. And that's the section that makes this strategy immediately usable. Before you leave, there are a few myths around HSAs that need to be cleared up fast. Myth number one, HSA is just for doctor bills. It's not true. That's the surface used, not the strategic use. Myth number two, it's too small to matter. Also not true. Used correctly over time, it can become a meaningful tax advantage asset. Myth number three, you should always spend it right away. Again, not if your goal is long-term tax efficiency. Myth number four, it's basically the same as an FSA. It is not. And myth number five, it helps with healthcare, not wealth building. That's exactly what high-income, smart W-2 earners understand differently. The HSA is not just a health account. Used the right way, it becomes a quiet but powerful part of a much larger tax strategy. And that's really the bigger takeaway from this entire video, because the smartest tax plans are not built around one tactic. They're built using the right tax strategies for you and your situation. If you want help figuring out what this the strategy should look like for you, here's the next step. If you're a high income W-2 earner making over $300,000 a year and you want help figuring out which legal tax strategies actually make sense for you and how to implement them the right way, then tap the top link in the description. Book your free tax strategy call with one of my team members. In the last 12 months, we've helped over 270 high income W-2 earners legally save over $12 million in taxes using personalized strategies tailored to their goals and situation. If you want to be our next case study, that call is where it all starts. And if you'd rather keep learning first, watch the next video on the screen. Cost segregation explained, the real estate strategy that lowers your taxes. And remember, your income should be building your wealth, not just funding the IRS.